In September of 1998, the global financial system was brought to the brink of total collapse not by a rogue nation, a sudden war, or a catastrophic natural disaster, but by an equation. A single hedge fund, armed with the brightest minds in modern finance, had quietly amassed a mountain of invisible risks so colossal that its failure threatened to vaporize the balance sheets of Wall Street's most venerable institutions. This was long-term capital management, an enterprise founded on the seductive, highly dangerous premise that the chaotic, unpredictable movements of global markets could be tamed by absolute mathematical certainty. The architect of this unprecedented financial experiment was John Meriwether. He was a legendary bond trader who had recently departed Salomon Brothers under a cloud of scandal, seeking to build a new empire free from the constraints of traditional banking oversight. Meriwether possessed an uncanny ability to read markets, but more importantly, he knew how to cultivate an aura of exclusive, unassailable genius. He designed his new firm to operate in total secrecy, creating a black box where even the elite investors providing the capital were denied access to the specific trading strategies being employed. The partners at the fund demanded exorbitant fees, taking a 25% cut of all profits, a figure far above the industry standard. Yet, investors clamored for entry, viewing the steep price of admission as a necessary toll to access an infallible money-making machine. To legitimize this secretive vision, Meriwether recruited the absolute titans of quantitative finance. His most notable acquisitions were Myron Scholes and Robert Merton. Their pioneering work on derivatives pricing had fundamentally altered modern economics, eventually earning them the Nobel Memorial Prize in Economic Sciences just 1 year prior to the fund's unraveling. The academic pedigree of these founders granted the firm an almost mythical status. Wall Street executives, desperate to align themselves with verified genius, effectively handed over their capital without demanding the customary transparency, blinded by the prestige of the men at the helm. The core engine driving this massive accumulation of wealth relied upon convergence arbitrage. This is a highly sophisticated trading maneuver designed to exploit tiny temporary price differences between mathematically related financial instruments. For example, the fund would simultaneously buy an older, slightly cheaper government bond while selling short a newer, slightly more expensive one. The proprietary models dictated that, over time, the prices of these two nearly identical assets must inevitably converge, locking in a guaranteed profit regardless of broader market direction. Because these price discrepancies were microscopic, often amounting to mere fractions of a cent, the strategy required staggering amounts of borrowed money. This borrowed capital, known as leverage, was utilized to magnify those tiny spreads into multi-billion-dollar windfalls. The profound danger of such extreme leverage is its function as a ruthless financial amplifier. It multiplies not only the potential gains, but also the devastating speed and scale of potential losses, leaving absolutely zero margin for error if the markets behave irrationally. Traditional banks might leverage their equity by a ratio of 10 to 1. Long-term capital management, shielded from regulatory scrutiny, routinely pushed their leverage ratio to 25 to 1, and eventually a staggering 30 to 1, balancing a skyscraper of debt upon a foundation of toothpicks. For 4 spectacular years, the equations performed flawlessly. The fund generated annualized returns exceeding 40%, attracting a breathless influx of capital from eager institutional investors, central banks, and the global elite. Intoxicated by their own uninterrupted success, the partners began to stray far from their foundational expertise in government bonds. They expanded their highly leveraged bets into corporate takeovers, mortgage-backed securities, and volatile emerging markets, convinced their algorithms could accurately price risk in any environment on Earth. Financial insiders began to describe the firm's strategy as picking up nickels in front of a steamroller. The profits were consistent and seemingly guaranteed, right up until the moment the machine suddenly accelerated. The arrogance of the firm was palpable. When traditional traders questioned the sheer volume of their positions, the partners would dismiss the concerns with mathematical proofs, treating market veterans as intellectual inferiors who simply lack the capacity to comprehend the new world order of quantitative finance. The fatal flaw in their grand architecture was a profound misunderstanding of human panic. Mathematical models are inherently backward-looking, built upon the assumption that future market behavior will inevitably mirror historical patterns, assuming a rational, normal distribution of risk. The first tremors of instability arrived in 1997 with the Asian financial crisis. Currency devaluation swept through Thailand, Indonesia, and South Korea, introducing a level of chaotic volatility that the firm's pristine historical data sets had failed to adequately capture. Rather than reducing their immense exposure, the fund viewed the widening price spreads as a temporary anomaly, an unparalleled opportunity to double down on their bets. The architects of the firm believed the markets were simply mispricing reality and that the equations would ultimately be vindicated. That foundational assumption shattered completely in August of 1998. The Russian government, battered by falling oil prices and the lingering economic contagion from Asia, did the unthinkable and defaulted on its sovereign debt, effectively declaring bankruptcy on the world stage. Global markets seized in a sudden, violent panic. This triggered a massive flight to quality, a psychological phenomenon where terrified investors indiscriminately dump risky assets and hoard the safest government bonds available, completely disregarding underlying mathematical valuations. This erratic, emotionally driven stampede was the exact opposite of what the Nobel laureates' equations had predicted. Instead of converging, the price spreads between the fund's disparate assets violently diverged, tearing massive, unpluggable holes in their highly leveraged portfolio. By late August, the situation had deteriorated into a relentless financial bloodbath. LTCM was hemorrhaging hundreds of millions of dollars a day, its equity rapidly obliterated by margin calls from panicked lenders. A margin call occurs when a broker demands that an investor deposit additional cash to cover potential losses on leveraged trades. As the fund's assets plummeted in value, their prime broker demanded massive infusions of cash collateral to secure the outstanding loans. To meet these margin calls, the firm was forced to liquidate its positions at fire sale prices, which only drove the value of their remaining assets down further. This created an inescapable death spiral of forced selling and mounting losses. The irony was suffocating. The very models designed to exploit market inefficiencies were now the primary cause of those inefficiencies. Every time the fund sold an asset to raise cash, they pushed the price of that asset further away from its historical norm, ensuring that their next necessary sale would be executed at an even steeper loss. On a single catastrophic day in early September, the fund lost $553 million. The sheer velocity of the capital destruction paralyzed the firm's leadership, who watched helplessly as their supposedly infallible risk management systems completely disintegrated. The true horror was not merely the death of an arrogant hedge fund. The terrifying reality was that this specific entity had woven itself deeply into the very foundation of the global financial system. Through a labyrinth of complex derivatives contracts, the fund owed staggering sums to over 50 of the world's largest banks. This created a web of systemic risk, a catastrophic scenario where the collapse of one highly interconnected entity could trigger a cascading chain reaction of global bankruptcies. At its peak, the firm held less than $5 billion in equity, but controlled over $100 billion in assets. Furthermore, their off-balance sheet derivatives positions represented a staggering notional value exceeding $1 trillion, tethering Wall Street's collective survival to the fund's fate. To put this into perspective, the total gross domestic product of the United States in 1998 was roughly $9.1 trillion. A single unregulated hedge fund in Greenwich, Connecticut, was managing derivative contracts with a notional value equal to more than 10% of the entire American economy. Recognizing the apocalyptic threat to the broader economy, regulators were forced to abandon their traditional stance of free market non-intervention. The Federal Reserve Bank of New York, acting as the ultimate arbiter of market stability, orchestrated an unprecedented emergency response. In a move that shocked the financial world, officials summoned the heads of Wall Street's most powerful institutions to a tense, closed-door meeting in Lower Manhattan. Competitors who routinely sought to destroy one another in the open market were suddenly forced to sit at the same table. The central bank presented them with a stark, unforgiving ultimatum. The banks, many of which had recklessly provided the leverage that fueled the crisis in the first place, were strong-armed into pooling $3.6 billion to recapitalize the dying fund. This was not a government bailout utilizing taxpayer money, but a heavily orchestrated private rescue. Wall Street was effectively forced to bail out its own reckless counterparty to prevent a mutual destruction that would have frozen global credit markets overnight. The intervention sparked immediate and fierce controversy among lawmakers and the public. As detailed in subsequent congressional testimonies, former Federal Reserve Chairman Alan Greenspan stated that the intervention was necessary because a default would have severely impaired the economies of many nations, including the United States. The immediate crisis was averted, and the global markets slowly regained their footing. The massive toxic portfolio was carefully dismantled over the following months, unwound piece by a consortium of banks to prevent further shocks to the fragile financial ecosystem. But while the institutional balance sheets were saved, the ideological damage was permanent. The rescue operation birthed a dangerous new precedent, cementing the concept of moral hazard, wherein massive financial institutions learn that they can privatize their immense profits while socializing their most catastrophic risks. The architects of the bailout argued they had saved the world from a localized depression. But by shielding the reckless lenders from the ultimate consequences of their greed, the central bank inadvertently signaled that extreme risk-taking would always be backstopped by institutional intervention, provided the potential blast radius was large enough. The quiet settlements behind those closed doors hinted at deeper systemic vulnerabilities that regulators chose to bandage rather than cure. The belief that certain institutions were simply too big to fail became an unspoken guarantee, setting the stage for the devastating global financial crisis exactly 1 decade later. The brilliant minds behind the equations were quietly dismissed, their reputations permanently fractured. John Meriwether, Myron Scholes, and Robert Merton watched their mathematical empire turn to ash, their legacy forever tethered not to their academic triumphs, but to the profound hubris of believing that the messy, irrational reality of human panic could be perfectly contained within a spreadsheet.